All right, class, settle in. Today, we're jumping into a topic that is not only super practical, but is also one the CRA absolutely loves to look at: shareholder loans. Now listen, for those of you who plan on advising owner-managed businesses someday, this isn't just nice-to-know information. It's absolutely critical. So let's get into it. Just a quick note before we really get started. The materials for today's lecture were put together by Dr. Samir Al-Rishani, with a little help from AI. So here's our game plan for today. We're going to start with the absolute basics. What are these loans anyway? Then we'll dive into the CRA's big, scary general rule. After that, the fun part, the key exceptions, or how you can get around that rule. We'll also unpack some tricky repayment rules and traps, and then we'll wrap it all up with the consequences and best practices you can take with you. Okay, first things first. Before we can even start to tackle the complex tax stuff, we all need to be on the exact same page. So, what really is a shareholder loan? Well, on the surface, it's pretty simple. A shareholder loan is exactly what it sounds like. A corporation lends some cash to one of its owners. Take a look at the example with Alice. She owns A Corp, and she needs 15 grand for a personal thing. Now, instead of A Corp paying her a salary, which would get taxed right away, the company just lends her the money. And right there, that's the big appeal. And also the big danger. You get cash out of your company without that immediate tax hit. And you can probably guess that the CRA has a few things to say about that. And that leads us to the million-dollar question, right? If it's just a loan, why is the Canada Revenue Agency so incredibly interested in it? Well, the answer comes down to one thing: the potential for tax avoidance. I mean, think about it. If there were no rules, what would stop a business owner from taking a bunch of money out, calling it a loan, and then just never paying it back? It would basically become a permanent tax-free salary. And the CRA's job is to make sure that doesn't happen. Which brings us right to the CRA's #1 weapon in this fight. I like to call it the hammer of the Income Tax Act. This is the default rule. This is the starting point for any analysis. And here it is, subsection 15.2. Everyone, write this down. Circle it, highlight it, put stars next to it. If you walk away remembering only one thing from this lecture, I want it to be subsection 15.2. It is the absolute foundation for everything else we're going to talk about today. So how does this big hammer actually work? Well, its default position is pretty harsh. It basically looks at that loan and says, nope, that's not a loan, that's income. Period. The entire loan amount has to be included on your personal tax return for the year you received the money. And notice how wide the net is cast. The borrower doesn't even have to be the shareholder. It can be a spouse or another connected person. The purpose is crystal clear: to stop people from taking tax-free money out of their company and letting it sit there forever. Okay, so if Section 15.2 is the big, scary hammer, are there any ways to avoid getting hit? Of course there are. The Income Tax Act provides a few very specific escape hatches. Let's check them out. These are the 4 main ways out. You can see there's an exception for repaying on time, one for companies whose business is lending money, another for specific shareholder-employee situations, and one for certain trusts. Now, for our purposes today, we are going to zero in on the 2 that you will see 99% of the time in the real world: the repayment window and the special loans for shareholder employees. This is the big one. This is the exception everyone tries to use, and it's found in subsection 15.2.6. The rule is this, and listen carefully. You have to repay the loan in full before the end of the corporation's next fiscal year. Let's walk through this timeline. The loan's taken in March of 2025. The company's year end is December 31st, 2025. The clock doesn't stop there. You get one more full year. So the absolute drop-dead deadline to repay is December 31st, 2026. It's a pretty generous window, but believe me, that deadline is rock solid. The other major escape hatch is for shareholder employees. But, and this is a huge but, it is not a free-for-all. There are very strict conditions. First, and this is the most critical part, the loan must be given to you in your capacity as an employee, not as an owner. The CRA wants to see that this is a legit employment perk. Second, there has to be a real bona fide arrangement to pay it back. And third, the loan has to be for one of these 3 specific things: to buy a house for you to live in, to buy new shares of the company, or to buy a vehicle you need for your job. That's it. You can't use this exception to fund a vacation. Okay, so you just have to repay the loan on time. Simple as that, right? Well, not so fast. This is actually where a ton of taxpayers get into serious trouble, because the CRA has built in a very specific anti-avoidance rule to catch people who try to get too clever. And this, right here, is the heart of the trap. The rule essentially says that if your repayment is just one part of a circular series of transactions, the CRA will pretend that repayment never even happened. This is designed for one reason, to stop the old repay and reborrow game. This slide shows it perfectly. On the left, that's a bona fide repayment. You clear the loan with real funds, like a salary or dividend from the corporation. That's a legitimate transaction. The debt is settled. But look at the right side. That's the classic trap. You repay the loan on December 28th, right before the deadline, probably with money you borrowed from a bank. Then, a few days later, on January 6th, you take a new loan from your corporation to pay back the bank. See the circle? The CRA sees right through that. They will deem the repayment invalid, and boom, the original loan gets added to your income. So, what happens if you just mess up? You miss the deadline, the loan gets included in your income, you pay a boatload of tax on it, and then you finally repay it a year later. Is all lost? Not entirely. There's a relief provision, paragraph 21J, that allows you to take a deduction in the year you finally make that repayment. It doesn't undo the tax and interest you already paid, but it does offset your income in the year you pay it back. So you eventually get tax relief for the amount you repaid. Okay, let's pull all this together. Now that we know the rules, the exceptions, and the traps, let's synthesize this all into some practical advice and a clear summary of what happens when things go wrong. This table is a fantastic summary for your notes. So to recap, fail to repay on time, and the whole loan becomes personal income, thanks to 15.2. If you try the series of loans trick, your repayment is deemed invalid. Two other things to watch out for. If you charge an interest rate that's too low, you'll have a taxable benefit under Section 80.4. And if the corporation just forgives the loan, that forgiven amount is also going to get taxed. The bottom line is, there is no free lunch here. So when you all are out there advising your future clients, how do you keep them out of trouble? You follow this checklist. You document everything with a proper loan agreement. You charge the right amount of interest. You keep meticulous records. And most importantly, you respect that repayment deadline and you avoid those cyclical repayment games. Your advice in this area is going to be absolutely invaluable to your clients one day. Which leaves us with this one last question. Is a shareholder loan a flexible financial tool, or is it a dangerous compliance trap? Well, as you know by now, the answer is, it's both. Used correctly, with proper documentation and a clear respect for the rules, it can be an incredibly flexible and useful tool for a business owner. But handled carelessly, it becomes a massive and very expensive tax problem. And the difference between the two lies entirely in understanding and applying the rules that we've gone over today.